Hello, everyone out there in podcast land. Welcome back to Adventure Capital, where we not only discuss the entrepreneurial journeys and adventures with founders who have raised capital on Wefunder, but also the different resource providers and mentors helping founders along the way. Huzzah! In this interview, we chat with Jason Garcia and Shelley Golan of Mercury and discuss their new venture debt offer, which you can use to enhance your VC round by getting minimally dilutive capital to extend your runway and hit milestones to reach a higher valuation at your next fundraise. Before we get on with the podcast, we're required to let everyone know that anything we say here should not be interpreted as investment advice, recommendations, or soliciting investments in any company. All companies raising on Wefunder are given an equal opportunity to participate in the podcast based on the progress of their campaign. Wefunder gang, take it away.
Hey guys, welcome to another episode of Adventure Capital. Delighted to be joined today by two folks on the Mercury team. We have Jason Garcia and Shelley Golan that are going to be telling us a little bit about Mercury's offerings with respect to venture debt, which I think could be a really great opportunity and option for Wefunder founders. Maybe we could start by you guys introducing yourselves, telling us a little about your background, your role on the Mercury team. And Shelley, do you want to go first?
Sure. Thanks, Jonny, for having us both. I'm Shelley. I'm one of the relationship managers at Mercury, and my background is as a founder. I founded I founded 3 startups, 2 of them in my hometown of New York, and one, kind of fully remote during COVID times. I moved on from my founder journey and I transitioned into the accelerator space, and I ran a edtech accelerator in New York and expanded it to the West Coast. And so I got, a lot of experience working with founders kind of on the other side of the table in that context. And really from there, it was a very natural evolution for me to join the team at Mercury to continue working with founders and assisting them navigate the ecosystem with as many resources as possible.
Love it. Thanks. Jason, what about you?
Yeah, so my background's in finance. I worked in public accounting and investment banking before joining Silicon Valley Bank and started banking startups. I was there for quite a while and did a lot of venture debt deals. That's where I learned about venture debt and the different banking options for startups. And then ultimately wanted to learn how to run companies. I've been CFO a couple times for a number of SaaS companies, and then was head of partnerships for a large fintech company called Divvy before co-founding a company with Bryce Roberts, building a financial marketplace for founders. And then, after that have found my way to Mercury. And my current role, I'm leading our capital teams and our relationship management teams.
Very cool. I'm really stoked to have both of you guys on the podcast. Firstly, because I think Mercury is a great product and hear amazing things from so many founders that have worked with you guys. And I think it can really benefit a lot of Wefunder founders. But also, obviously, because you guys decided to open up a community around on Wefunder last year. We have a Slack channel. I don't know if you guys know this, but we have a Slack channel of investments. So every time someone invests on Wefunder, we see, an entry in the Slack channel. When I joined Wefunder in early 2018, the Slack channel would ping a handful of times a day. And these days, it's thankfully harder to keep up with it. But the day that Mercury launched their Wefunder round was probably the most explosive day in the history of that Slack channel, and just saw so many thousands of your customers pile in to invest in you guys. So, not allowed to have favorites here at Wefunder, but the Mercury raise, when Imad kind of said, okay, well, we just closed this 120 million Series B from Cotu and Andreessen, but even though we don't need the money, we're going to open it up to our fans and customers and community to invest in us alongside A16Z, was just really, really cool. So thank you to you and your team for using Wefunder to raise part of your Series B. And it's doubly awesome to have you guys on the podcast. But For those listeners that don't know, maybe you could start by at a high level just giving us the overview on what you guys are building with Mercury.
Yeah, and thanks for supporting us with that. I feel like Wefunder, you guys have built a great product and have helped us. I think through doing that with you all, we've been able to align some incentives with customers as well and have them be a part of the journey in a larger way. So it's been a great partnership, and I appreciate working with you all.
I can't let that slide, Jason, without just pausing for a second on that. So do you have an example of what you mean by that?
Yeah, I think I had a number of clients and customers reach out at the time that we did this that were just really excited about. They love the product. They love working with us. They have a vision for us as a company succeeding, and this allows them to be along for the journey, and not only contributing towards that success, but then also being a part of that success as well. So yeah, there's a lot of excitement. I feel like a lot of companies have also had interest since we did that last year.
Love that.
But yeah, so Mercury, sorry. Yeah, so Mercury as again, I think our focus is building financial products and banking products for founders, and making their normal day-to-day kind of banking experience a more delightful experience. One of the reasons why Mercury was built, and our CEO Ahmad and the co-founders, they are serial entrepreneurs. They've had to work with a number of banks in the past, and we're really frustrated with the experience that banking in general, you just kind of had to suffer through whatever the software product was or general product experience to take advantage of this really crucial core piece of your business. And so they set out to build just an easier, more intuitive way to receive payments, send payments. And so Mercury originally was that, just started holding your deposits, being able to send and receive transactions, wire, ACH, and check. And we have then kind of expanded from there. We now have some investment options for you, which is with one of our beta products, which is called Treasury. And then we most recently just launched our venture debt product, which allows you to also capitalize or finance your business as well.
Love it. Before we get to the venture debt, just curious, maybe Shelley, if you could articulate some of the biggest challenges that some of the most undelightful problems that the team has kind of seen or maybe personally experienced startup founders having as they're building their companies with respect to the kind of legacy or kind of incumbent banking solutions.
Yeah, well, speaking as a former founder, and just to keep it real with our listeners and probably most of the people that are part of the kind of Wefunder ecosystem, is business banking sucks. And it's often, the part of your business that is both the most unavoidable and the part that you most want to avoid because of how painful it is. And that's not even because founders don't have the capacity to, run their own banking or finances, just the systems that we have in place. Banks as a service haven't really been updated in a very long time, 30 years, at least 40 years. And so much of our lives that are now done on mobile, remotely on the internet, a lot of these systems are just not built for ease of use. And many of them just lack any type of intuitive usability.
So is that a specific kind of example of one of the problems then? For example, my Wells Fargo mobile app is really horrible. Is that kind of a leading example there?
Yeah. Go ahead, Jason.
Yeah, I was going to give just a small example, which I feel like is pretty core to startups and raising money, is wire instructions, which I feel like is a small example, but fairly crucial and frequently used by startups. At other banks, you got to call somebody or email somebody to get your wiring instructions, or it's very hidden within the UI. Whereas with Mercury, you go in, click whatever account that you want to have wired, money wired into, And right there, you have a PDF that you can download and just email off to all the parties that are investing in your company or whatever other reason you might need to have the wire come in.
Just to double down on that, I tried to send a wire from Wells Fargo the other day, and like I had to go into a branch to send it. And then when I got to the branch, this is not a joke. They said, oh, the person who does the wire, there's like 5 people in the branch. And they were like, oh, the person that can do the wire transfer, which I guess is the bank manager, is like out for lunch. And so then I just like driven like 10 minutes to the bank, parked, got out, like totally disrupted the middle of my day. And now like I have to go back. And it's just like, wait, this seems like it should not be a thing in 2022.
Exactly. Yep.
So you mentioned venture debt, the venture debt offering that you guys have. Shelley, at a high level, what is venture debt?
Well, venture debt at a high level, and Jason can provide more detail on this, is a loan that is given out to high growth startups in partnership with their equity raise. And so it's a very, kind of specific category of loan that is given after you've raised venture capital.
Are there standard terms? Like what kind of, what triggers it? For example, like, is it a percentage of the round? Is it kind of triggered by, is it a certain kind of tier of VCs? Like, would any kind of institutional investor count as kind of, eligibility for venture debt? What are the kind of interest rate terms, etc.?
Yeah, good question. The majority of Series A companies will take a form of debt like this. So to give some context too, and seed stage companies, now that they're raising more money, a lot of them, like those rounds growing in size, a lot of them are taking advantage of this as well. In terms of the way it looks, it's typically 25 to 50% of whatever the equity round is that they just raised. The average amount that people take is about a third of the round, so 33% of your equity round you might access in venture debt. It's fairly cheap money if you're getting it from the banks. You can actually access this from 2 different types of providers. Generally, the market's kind of split up in 2. You've got venture debt funds, and there's a number of great ones out there. They may actually go more aggressive on size, but they're maybe a little bit more expensive. So you're going to be somewhere in the 10% plus in interest rate. And we're going to land amongst all of the venture banks. And that's going to be, low interest rates. Today, it's all based on prime, the prime rate. And prime today is at about 3.5%. And so venture debt all in with the kind of markup of that rate is somewhere between 4.5% to maybe 5.5% in interest. And you're really only paying that on whatever you borrow. So if you take the loan, but you don't borrow a portion of it, you don't pay interest on that piece of it. So that's
almost like a line of credit in that sense.
It's basically like an available loan to you. It's not necessarily a line of credit where you could like borrow it down and pay it back and borrow it down and pay it back. But in the idea that like, hey, I don't have to take it day one. Yeah. There's usually like what we call a draw period, which is a period of time which you can choose. Yeah.
Yeah. So is that period of time like X months after the closing of the Series A, let's say?
Exactly. Yeah. So the loans are typically 4-year loans in total, and that clock starts once you sign the agreement. And then, there's this initial period, and on average, it's probably somewhere between 12 to 18 months. So for your first 12 to 18 months, you don't have to borrow the loan if you don't want to. Mm-hmm. And then at the end of that period, though, you've got to choose. Are you going to borrow it or you're not? If you don't, then you don't have access to the loan anymore.
Right.
If you do, then you pay back whatever the portion is that you borrowed. You pay that back equally over the rest of the loan. So going back to the example, 4-year loan, 12 months is a draw period. You don't have to borrow anything for the first 12 months. But then last day of that 12-month period, you borrow everything, you pay back everything equally over the next 36 months.
And
or the
can
next 3 years.
At the end of that 12-month draw period, can you decide I want to borrow half of that money?
Yeah. Yep. Yeah. There's
Up to
you don't have to borrow all of it.
Total value of the principal.
Exactly. Yep.
Got it. And so one stat that you mentioned earlier, we were talking about this the other day, and I was just blown away, is the frequency of this, how common this is. What percentage? I think I can't remember the stat now, but what percentage of like Series A, Series B, even now as seed rounds are getting bigger, seed stage, companies are, taking advantage of venture debt?
Yeah, we'd like to do more of an extensive kind of study, but in talking with a number of firms and just the data that we've pulled, on average, we think Series A companies, it's somewhere around 75% plus.
Wow.
Access some kind of loan like this.
And is that like you have the option of which like only if you're
correct
exercising that option?
Yep. So that's a very good tying back the previous topic. This doesn't mean that they actually borrow on the loan. That just means that they got a loan in place.
Right.
And for a lot of companies, especially Series A, they like, why it's cheap money. I'm not paying interest on the portion that I don't borrow. Right. Why not put that in place today and then have access to it if I need it? And I would guess, there's a good portion of that population that doesn't ever borrow on the loan because they won't ever need it. But why not just put it in place? So again, Series A, it's probably 75% plus. On seed, one of the one of the research groups we've talked to has said it's probably somewhere around 50% on seed, which was kind of surprising to me. But I guess with seed round being 5-6 million, that makes sense. And then the Series B and beyond, they typically access lines of credit and different types of products, but there's still a portion of that population that's accessing something like this.
Got it. This is maybe a dumb question, but are companies using the next round? Like if they raise venture debt in Series A, are they, like when they raise into Series B, are they using those kind of dollars to pay off the venture debt loan from the A round? That doesn't seem like something that a venture capitalist in the Series B round will be stoked about their investment going towards.
Yeah. So typically what will happen is once you take venture debt, you're typically accessing it again and again every single round that you get. So if you're in this
back with the next loan kind of thing.
Exactly. So I raise my Series A. I take a $5 million venture debt loan. I wait until the absolute last day possible to borrow it all down. I borrow it all down, and then I raise my Series B 6 to 12 months after that. Sometimes they'll take the equity dollars and pay down the loan and then put a new loan in place and then not borrow anything for a portion of time to save on interest. Sometimes they'll just leave it out. But typically what's not happening is they're like taking the equity dollars, paying off the loan, and then not getting a new loan in place, because that's fairly expensive. And again, to your point, VCs are investing in your business to invest in growth, not investing in your business to invest in, paying off loans. And we're similarly kind of aligned. We want our capital to be going towards growth and not a blocker or a drag on cash.
And obviously you're tying up the cash flows in kind of paying back the loan in a sense that we do got to pay it back, maybe out of the venture debt that you secure in the next round. But it also gives you a lot more capital that you can use to accelerate the growth in the interim. So it's obviously
exactly
aimed at accelerating the growth as opposed to sucking up cash flows that might constrain it.
And that to that point, like that is a pro and a con here, depending on how you look at it, right? Like the pro is you have access to venture debt. You can double down on growth. The con to it is it's a loan. You still have to pay it back. So typically we try to guide companies to having line of sight in their business that suggests that they could support a loan. So if you are completely pre-product, pre-revenue, still not quite sure what product market fit looks like, you might want to be careful about thinking about taking venture debt, because you don't want to find yourself in a situation where you got to pay back that loan and you don't quite know how to do that.
That when you say kind of, seed rounds are increasing, and so maybe venture debt is kind of infringing more on like seed territory versus, I mean, yeah, the company's Series A, okay, they've figured out product market fit, everything's a little bit more predictable. Like if you're kind of, if more companies are taking on venture debt at the seed round, is there a risk there that they might get into trouble, you think?
There is, yeah. I mean, again, like, the difference between equity and debt is the debt has structured repayment that you've got to make. And so if you're a seed stage company and you don't have an understanding of how you're going to make those payments beyond just equity fueling that, it's a risky proposition. But, there's plenty of companies that raise seed, and especially with, SaaS products that can generate revenue very, very early. And it feels like our teams are building so fast these days that they can get to revenue generation quite quickly. If you're in that bucket, you're raising a seed round, or you were a bootstrapper for the last 2 years and you just raised your first round, you call it a seed round. Like, yeah, we debt could really fit your business.
There's a spectrum of seed rounds, a spectrum of kind of predictability of revenue of companies at the seed stage, basically. And
exactly
kind of, reliable or robust companies with kind of stable projections. Even at seed round, maybe it's a good fit. Okay, the ones that are pre-launch or kind of haven't hit product market fit yet, maybe less of a fit.
Right. Yeah.
One more thing just to put in here as well is part of the process with Mercury when we go through a venture debt kind of diligence flow is we have the relationship managers and also our capital advisors who take a lot of time to look at every aspect of a company. And so our goal isn't to just give debt to anyone who applies because we want to. Our goal is to really make sure that the loans we give out will actually be useful to our founders. And so we have a lot of checks and kind of triggers that we look out for to make sure that we call them capital advisors for a reason. And if we think that a seed company is a little too early or for whatever reason, maybe they need to have a couple more levers in place before we would feel more secure, then we coach those founders, what to think about and what to look forward to, what milestones we want to see before, we'd feel comfortable on their behalf and on our behalf to take on a loan.
That's actually a beautiful segue to the next question, which is around what are the pros and cons of taking on venture debt, or maybe another way of asking that question, like which startups are a good fit for venture debt? Like who would you? I mean, there's obviously kind of have the ability to repay, but then there's also like, okay, you can have the ability to repay and you don't necessarily need venture debt, or you shouldn't necessarily take on venture debt. Like, what are the types of companies that it's like, this is a really good fit versus less of a fit?
Yeah, so we look for companies, or to rephrase, companies that are great candidates for venture debt are startups that are ready to embark or have embarked on their seed round or Series A with institutional investors. And so this would be, maybe after they've done their friends and family or community round, and now they're looking for venture capital from institutional VC. That would be sort of one of the primary things we look for when we determine a company's eligibility. And on that front, we want to see that companies are raising at least $2 million from institutional capital. And this is, again, ties into our underwriting process. We want to be able to provide a loan that, significantly can increase a founder's runway and really give them the necessary boost that they need on their raise to reach more milestones and hopefully increase their valuation before they have to raise again. So high level, those are some of the requirements we look for. I don't know if you have anything else to add, probably Jason, on what we look for venture debt companies.
And I guess just to build on that, like let's say there's 100 companies that have raised, $2 million in institutional venture dollars. Like if you were to rank those 100 companies, like what is the top, like of those 100, like what are the best fits where it's like, this is definitely going to be in your interest, Mrs. Founder, to take on venture debt versus like, actually, no, even though technically you're eligible, we probably wouldn't recommend this for this reason.
Yeah. It's a good question. I mean, there's like a really broad spectrum of companies that we probably could talk about. I'll give you just a couple of examples. One of them would be um, a SaaS company or any kind of company that really understands their unit economics. They know what it looks like when they invest $1 into customer acquisition, what the profitability of a customer looks like, and how quickly that repays. Because again, like our debt, like if you can use our debt rather than equity, and you can pump it in to this revenue generating model, then we can give you those extra dollars that are going to only increase the profit of your company, or at least the bottom that your operating profit. You're probably not truly profitable quite yet, but yeah. So like anything on this that's accretive, if you're investing in anything accretive in your business, that's a smart way to go. Another way also to think about it is if you are trying to get to the next milestone of a company, and you have a really, really good idea of what, if you're a Series A company, you know exactly what milestones you need to hit in Series B, and your confidence level is really, really high that you can hit those Series B milestones. And a lot of times those might be revenue milestones, or maybe it's a product milestone, but you have a good idea of what that looks like. Venture debt can fit that as well, because, and especially if you can reach that within 4 years of taking the loan, because again, the loan is a 4-year maturity. And so if you take that loan, you can accelerate your timeline. Maybe that's, again, using an example of product, maybe you could move faster. You're more confident if you could have an extra $2 million investing into a certain R&D or product team. We can help you with that. The advantage also taking our capital versus taking equity in that is that you're paying interest to us, and fairly low interest, and we're saving you, percentage points on your cap table and ownership. So we can give you the runway if you're confident that you can hit it within that time period, and we're saving you ownership on your cap table.
Yeah, so the pros of venture debt are super clear, right? It's like, okay, you get extra capital, especially as you say, if you have clear line of sight of unit economics. If you have a relatively quick, okay, we invest this much in CAC, turns this much LTV around, that can relatively short order, great. And to your point, like way cheaper to raise that, we're paying a 4% interest rate than giving up additional points of your cap table that hopefully, if you build a huge business that scales, you might be paying 100x on. That's a pretty high interest rate on a loan, right? So if you would do the math, so that's kind of the pros for founders. What are the downsides? Like, why would someone, like if they raise a Series A, why would they not take on venture debt?
Yeah, I think, like, again, going back to that example, if you've got the confidence that that if, let's say the venture debt loan is $2 million, you got this choice of either raising $2 more million in equity or $2 million in a venture debt loan. If you are confident that you're going to be able to execute and either get to that next round of funding, or you're confident that you're going to be able to execute and grow the business in a significant way, or even get to profitability, venture debt is going to be much cheaper for the company. If you look at the cost from the cost of capital perspective, when you convert the equity at exit, it's going to be really expensive, even on an annualized basis, right? But in order to have that thesis play out, you have to have confidence that's going to work, and not only confidence, but some proof of life there and evidence that you're going to be able to do that. Why wouldn't you do that? Is if you're still kind of speculating on the business, and you've got this idea and you're building out this product, but maybe you've got a ton of churn, and there's some level of uncertainty that this loan is going to translate into some positive ROI for the business that is going to ultimately keep the business funded. That's when you wouldn't want to do it. I'm maybe it's even, in med devices, I'm building something out, but my entire business hinges and relies on FDA approval, and I'm not even going to have an idea of what that approval looks like in the next 6 years. It's a riskier proposition to take the venture debt over equity.
I touched on this earlier, but Shelley, you mentioned if you raise 2 million in institutional capital, you may be eligible. So let's talk and explore it. And obviously, your team is kind of talking with founders, understanding their economics in more detail. Doing kind of additional diligence and exploring the fit. But with that $2 million, is there like a list of approved VCs or institutional investors that you guys would look to, or could it be any old family office counts towards that criteria?
So we don't have like a set list. That's like, if you have this person on your cap table, that's an automatic check. It's a lot more, I would say.
Bespoke.
Pardon? Yeah, bespoke, and I was going to say more holistic.
Right.
We take multiple factors into account,
Cool.
of which the cap table is one of them, and sort of the individuals or entities on the cap table is one of them. I will say on the eligibility side, the reason that we continuously specify that we're looking for institutional investors, we do want to see a majority of the cap table be from institutional investors.
Mhm.
And that's only because we are able to make our kind of decisions and underwriting to an extent based on the track record of the institutional VCs in a way that we cannot extend the same process to family offices or angels. So that's really the difference. It's not to say that the family offices or the angels in the cap table are not incredibly valuable and high value contributors to the cap table. It's
kind of
yeah,
underwrite that and say, okay, let's look at
right.
Yeah.
Exactly.
What one question I'm curious on, like, how do VCs? I presume VCs are super stoked on venture debt, but it's like, on one hand you could see it as like, well, we want to put more of our dollars in as equity funding, then we won't take up the founders cash flows in loan repayments, and more importantly, like, I get a bigger piece of the pie here. So is there any kind of like competition? Like, I think about this sometimes when we're talking with other potential funders, and there's the kind of Wefunder piece, and then there's there's a revenue share funder, and there's kind of this weird like dynamic of, well, it's kind of collaboration, and there's kind of shared deal flow, but then there's also like maybe some cannibalization or competition. How do VCs view venture debt?
Yeah, it can be competitive at some level. It depends on what state of mind that VC is in. If they invested in a company and they didn't get the target ownership they wanted,
Right.
then yeah, I think they're going to try to sell to the company, hey, why don't I just do that extra 2 million for you? And then, but I would say generally, like, if the VC is already invested at the level that they want to be invested, and they made it into the company already, they're sitting on the cap table. Maybe company just raised the Series A and they invested at the seed. Typically, those investors really like us being there because of the leverage that we give them. Because we don't only save ownership for founders, we also save ownership for the VCs
exactly.
as well.
That's more points of equity that the founder can give out to employees, an option pool, or for that VC down the line. So yeah, it's really interesting. Like, you could kind of see it going both ways.
Yeah, but then I would also say that, like, generally VCs also are also weary of what I was talking about earlier, which is, if the company's really not found their way, right? They're still kind of like searching for that product market fit, and they're out in the wilderness kind of trying to find it. I think VCs typically are always kind of looking for that inside of their portfolio companies, and so they're weary that the company takes venture debt too early, which I think is right. As being the governance voice in the company, they need to make sure that it's appropriate.
Yeah. So Silicon Valley Bank, you mentioned, Jason, I think you came to Mercury from SVB. You mentioned them earlier in the conversation. I feel like that's the name that most people probably think of. It. I imagine they're the biggest player when it comes to venture debt. I don't know if you guys have the market share stats, but curious how you guys position Mercury. Obviously, Imad and the team kind of founded Mercury with the intent to, provide a more delightful experience. I love that word that you mentioned for your customers and for startups. How are you kind of providing that more delightful experience when it comes to venture debt? How do you position and differentiate Mercury versus like an SVB?
Yeah, SVB is great at what they do, and again, like you said, I spent 5 years of my career there. Learned a ton from that group, and they're an amazing organization. They've really kind of defined this category for a very, very long time. I think where we differentiate and where we're trying to innovate or make the process better, there's a couple of areas. One, it's fairly painful to do a loan generally within the venture banking ecosystem, whether it's SVB or the others. And what I mean by that is that loan process looks like a very commercial loan process. It's very manual. You're on phone calls quite a bit, or you're getting together in person. It may take a couple of weeks to really kind of get the diligence process going.
Hopefully it's
and so
or maybe not, but like I've borrowed a couple of mortgages in my life now, and wow, that is
exactly.
Well, that is a process that needs some automation, needs some technology applied to it. I imagine there's some parallels.
Yeah, that's a big part of it. And like, it's you probably talk to your banking provider about a mortgage. And they've got all this information about you already, but then when you apply for a mortgage, you fill out all these applications all over again as if they never even knew who you were. Same exact thing, that you have here. If you're getting a credit card or a loan from a commercial bank in most cases, you are filling it out all over again. And that's one area where we're making and streamlining things, is we're leveraging some of the data that we've already got on you. Then just try not to ask you the same question twice, whether you filled it out a year ago or you filled it out last month. The other thing, like an example that I would say that where we're trying to make it more delightful, is when you take one of these loans, you have to send your bank reporting information every single month. So you need to send them what's the health of the company look like, its balance sheet or income statement. And the way it's typically worked in the past is they export it from the QuickBooks or whatever accounting system they're using. They send it in an email over to the banker, and every single month, right? And so there's this like monthly chore that you've got to do. Right. Well, these accounting systems now have really good APIs, and so we've built an API to be able to pull that information from those from our clients, so that we don't have this monthly chore. And so we basically turn that monthly chore into like an autopilot type process, rather than making them stop at the end of the month every single month to send us an email.
A little more tech friendly, a little more streamlined, a little less time and effort on the part of the customer. I love that. One question I'm curious about, when a VC invests, sure, it's money, but VCs are trying to differentiate based on, the value add that we can bring, right? Like, we're going to open up our Rolodex, we're going to, help you with recruiting, connections to customers, etc. Is Mercury trying to differentiate as well, from a sense of like, we're going to provide this kind of value added services and support on top of the money? Or is it kind of, obviously there's the, it's just be the process and saving time, but is there any kind of value added kind of element to how you're trying to compete and differentiate as well, or no?
Well, there are a couple of areas that I think we differentiate and add value. The first being that our team is very intentionally built to be founder focused. Mm-hmm. And that's represented by the fact that all three of our relationship managers are former founders, and even, Jason and other members of our capital team have operational experience. So there's a level of empathy that we come to the table with that.
Just to double down on that. I couldn't agree more. I think that is like so important, right? And just really to have someone that has been in your shoes be sitting on the other side of the table from you, it's kind of I think this, we hope that this characterizes us at Wefunder as well. So many of the people on our team are former founders and founder types. And so, yeah, I think that's probably like underappreciated by people, like how valuable that can be to have someone sitting in the on the other side of the desk who has trodden that path and gets your frustrations and has empathy.
Yeah, I mean, I think that we have, unlike other places, we don't separate between the hats. We have our founder hats and we have our banking hats, and we don't believe that there should be, they should be siloed. There's a lot of overlap between them, and being able to communicate with founders from a place of being there and having been there, I think just contributes to founders feeling like their needs and their concerns are valid, particularly when you're navigating a venture debt process or even when you're navigating a raise. These are also very highly stressful, intense parts of your founder journey. And many founders, they're not every founder is necessarily a CFO or a financial wizard or has some type of finance background. Many of them are just really good operators and believers in building a company. And so we ask of founders to take on this whole other responsibility of managing, these kind of more complex financial and banking transactions and products. And our attitude from our team and across Mercury is we want to be able to be guiding founders and not make them feel alienated or ashamed if they don't know an answer. And that speaks to me personally, having worked with many founders from different parts of the ecosystem. I think that founders beat themselves up too much, like, oh, I should know this, or I feel dumb that I don't understand the vagaries of like safe terms versus price rounds. You're not really supposed to unless you went to business school or were a VC. You're doing
a raising capital, right? It's oftentimes the first time that they've done it.
Yeah.
Or I guess if they're at Series A, maybe the second or third time, maybe it's a repeat startup. But like, VCs are doing this multiple times, like every day, every week, right? It's like, you and me, we're like dealing with this hundreds of times. But for founders, like, it's not their area of expertise. And so, yeah, we try to adopt that approach as well, of just eliminating jargon.
Yeah, and in that regard, the cards are stacked. Obviously, if you're a VC and all you do all day is deal in term sheets, you're gonna be a lot more capable of managing term sheets. And for a founder, not only might it be their first time, but they also have a million and one other things on their minds in terms of running their company while they're trying to complete a raise or apply for venture. So that really contributes to, I think, one of the differentiators, and also to extend onto what differentiates our product from other banks. It's not just the human element, but it's also the care and thought that we've put into the product itself. So just like Jason mentioned, the fact that we have this automation around the accounting aspect, we've taken the same care and intention across the entire process of the venture debt loan. And so we're really trying to minimize a lot of the kind of more outdated, painful ways that you navigate these processes by automating wherever we can, productizing wherever we can. Like, let's not waste anyone's time and try to move through this like quickly and with compassion, but also get shit done, right?
Love that. As we're coming to land, just before a couple of last questions on how people can apply and a piece of advice for founders that you guys would have. But before we get to that, just want to see if there's anything else that we didn't cover on venture debt or Mercury that you guys would really like to draw people's attention to.
No, not necessarily. I will maybe just add something to the last thing that you were asking about, where you said, what VCs have done to add value. We've all heard horror stories about that VC that's adding value and, sidelines a board call or is too intrusive in the business. And I think, the truly value add investors are the ones that know when to interrupt and jump in, right? And when to be quiet and be in the background. And similarly, I think to how Shelley's explaining the thoughtfulness of the product, I think that's one thing we've done really well, which is you want to send money from here to the UK to pay a vendor. we help you do that
Yeah.
without teaching you what a wire is and how the financial institution, right, financial system works generally. We try to remove all of the complexity and annoying aspects of banking and finance in general to just let the founders do the objective that they're trying to do. I think that's value in and of itself, which is like not distracting you from your founder day to day to just do some simple things that is the core of our business, but really shouldn't be the core of yours.
Well, what you were just saying as well made me think of potentially another example, which is, I've had a friend that, has been fired by VCs who kind of lost control of the company, right? So I would imagine there's maybe a kind of benefit around control as well as to, taking on venture debt, giving up less control. To your point just now about, sometimes you can have investors who are maybe intrusive, and I would imagine like, it's okay, you raised 5 million and then supplement it with additional 2 million of venture debt. That's relatively less obtrusive capital. That's kind of a little bit more passive. Is that fair to say?
Yep. Yeah, I think so.
Well, cool, guys. Thanks so much for coming on. Just as we close, if founders are interested in learning more about venture debt, is there a good resource where they can go to do that? And also, where can they learn more about potentially becoming a Mercury customer or learning more about the suite of products and services that you guys provide?
Sure. Well, if any founder is interested in applying for venture debt, you could go to our website, mercury.com/venture debt, and you will be navigating through a pretty easy application. It's, I think, just like 3 or 4 steps. And we'll be able to respond to you within a day or two if you qualify. And then if you're interested in opening an account at Mercury, you could also go to our website and start that process. And we're always available if you want to reach out to us. We'd love to hear from anyone who's interested in learning more about any of our products.
Love it. Last question, and you can't say, go to Mercury versus SVB as your source of venture debt. Apart from that, which is obvious, one other piece of advice for a founder who's growing a startup. Jason, you want to start?
Sure. And this is generally on anything startup related. Yeah, I would say I feel like one of the best advice that I was given was actually from my co-founder and an investor on on Intro when I founded that company, which was things are typically not as bad as it seems. You have ups and downs in startups.
And probably they're not as good as they seem as well.
Exactly.
Well, yeah.
Yeah. And the key to a startup a lot of times is just not getting off the ride, riding, the ride in the waves up and down and not quitting too soon and kind of sticking with it. We all have issues. And when you zoom out, those problems on the day-to-day basis become smaller and smaller over time, over weeks and months and years.
Jason, your voice is very calm and calming. So I would think that when you're in the trenches and that some bad stuff is happening on the Mercury journey, I imagine you're a good guy to have on the team. Shelley, what about you? Bring us home. One piece of advice for founders.
My piece of advice, I agree, Jason does have a very calming voice. But a piece of advice I have for founders is don't underestimate the importance of building a support network of fellow founders. I have had so many instances in my own founder journey and to this day of relationships that I made with fellow founders, who've gone on to build incredible companies. And it's just a way to create a support system, but then also to access resources from your peers. And, being generous with your network, I think rarely bites you in the butt, within reason, of course. But yeah, build a support network and try to add value to your network in the same way that you hope to get value from yours.
I love that. I actually need to take that advice. I feel like I spend a lot of time chatting with founders, but I feel like people in my role, kind of running a great team, I could do a much better job of trying to build relationships with people that are doing a similar thing at other companies. So I need to take that advice myself. Thanks so much. This was a really interesting conversation. I learned a lot. I think it's going to be really interesting for folks that are just kind of exploring this idea of venture debt. So really appreciate both of you taking the time to come on it. Hopefully it might be of a lot of interest to a bunch of founders in the Wefunder community who are listening. Jason and Shelley from Mercury, thanks so much, guys.
Thank you.
Thanks for having us.
Thank you for tuning into another episode of Adventure Capital. I hope you laughed, took notes, shed a tear, and most importantly, feel ready to go off on your own adventure. And remember, whenever you're ready, Wefunder's here to help. Be sure to like and leave a review, gang.